Most traders believe success comes from finding the perfect strategy, the perfect indicator, the perfect entry. But what if I told you the biggest difference between winning and losing doesn't come from what you trade, but from one small rule you either follow or ignore? Let me ask you something. How many times have you known exactly what you should do and still didn't do it? That's where the story begins. Watch any trader long enough, and a pattern emerges, not in the charts, but in their behavior. They'll study setups, mark levels, wait patiently, and then, at the critical moment, something shifts. They hesitate, or they rush, or worse, they abandon their own rule. Have you noticed that? That moment when logic gives way to impulse. It doesn't look dramatic from the outside. No alarms go off, no flashing lights. Just a small decision, almost invisible. But that's the point. The decisions that shape a trader's outcome rarely feel big in the moment. They feel reasonable, skipping a stop loss just this once, adding to a losing trade because it'll come back, entering early because it's close enough. Tell me, how often do traders actually blow up from one bad strategy? And how often do they unravel from a series of small, broken rules? You already know the answer. The market doesn't punish you immediately for breaking a rule. That's what makes it dangerous. You break a rule, and sometimes you win, and that's where the trap is set. Because now your mind starts rewriting the story. It says, see, the rule wasn't necessary. It replaces discipline with flexibility and calls it intelligence. But here's the quiet truth: consistency in trading isn't built on outcomes. It's built on behavior. If you only follow your rules when they feel right, then you don't have rules. You have preferences. And preferences don't survive pressure. Think about it. What happens when the market moves fast? When you're down more than expected? When fear starts whispering? Do you rely on logic in that moment, or on habit? That's why a small rule matters. Not because of what it does once, but because of what it shapes over time. A single rule, followed without exception, builds something most traders never develop: reliability. Not in the market, but in themselves. So let me ask you, do you trust your system, or are you still negotiating with it every day? Now here's where it gets interesting. When you ignore a small rule, you're not just changing one trade, you're altering your entire decision framework, because every exception creates a new reference point. The next time you face a similar situation, your mind doesn't go back to the rule. It goes back to the exception. And slowly, without realizing it, your system starts drifting. What began as a clear structure becomes a flexible suggestion, and flexibility in trading often disguises uncertainty. Have you ever felt like your strategy oozed to work, but somehow stopped? What if the strategy didn't change, but your adherence to it did? This is the part most traders overlook. They think the edge lies in the method, but the real edge lies in execution. Two traders can use the same setup and get completely different results. Why? Because one follows the rule every time, and the other follows it when it's comfortable. And comfort in trading is rarely aligned with correctness. So what's the real cost of breaking a small rule? It's not the loss. Losses are part of the game. The real cost is the erosion of trust. Trust in your system, trust in your process, and most importantly, trust in your own decisions. Without that, even the best strategy becomes unusable. So how do you apply this? Not in theory, but in the middle of a live market. Start by choosing one rule. Not 20. One. Something simple, something clear, something measurable. It could be: always use a stop loss. Never risk more than a fixed percentage. Only enter after confirmation. But here's the key: once you choose it, you don't negotiate with it. Not when the setup looks too good. Not when you're recovering losses. Not when you're feeling confident. Especially not then. Let me ask you, what would happen if you followed just one rule with absolute consistency for the next 30 trades? Not perfectly timed entries, not flawless analysis, just one rule executed without exception. Would your results improve? Maybe. But more importantly, your clarity would improve. Because now every outcome becomes clean. You know whether the system works or whether you didn't follow it. There's no confusion, no guessing, and that clarity is powerful. Another thing, start paying attention to your decision moments, not just your results. Right before you break a rule, what do you feel? Is it urgency? Fear? Overconfidence? That's where the real work is. Because trading isn't just about reading the market. It's about reading yourself in real time. And once you can recognize that moment, that subtle shift before a bad decision, you gain something most traders never develop: control. Not over the market. That's impossible. But over your actions within it. And that's enough. Now think about this. If one small rule can stabilize your behavior, what happens when you build a foundation of them, one by one, each tested, each earned, each followed without exception? Does your trading become more complex or more simple? Does your stress increase or decrease? And more importantly, does your confidence come from prediction or from process? Because there's a difference. One depends on being right. The other depends on being consistent. And consistency, over time, has a way of revealing truths the market never shows to those who keep changing their approach. So the next time you're in a trade and you feel that urge to bend your rule, just slightly, just this once, pause. Ask yourself, am I making a decision or am I making an exception? Because that small moment, that barely noticeable choice, that's where the real trade is happening. And whether you realize it or not, that decision is shaping not just this outcome, but every outcome that follows. The market rewards discipline, not intelligence. That idea unsettles most traders at first. It sounds almost unfair. After all, shouldn't the smartest person, the one with the best analysis, the deepest understanding, the sharpest predictions, come out ahead? But look closer at real trading behavior. How many intelligent traders do you know who still struggle to stay consistent? They can explain market structure, break down macro trends, and predict scenarios with impressive accuracy. Yet, when it comes time to execute, something slips. A rule gets bent. A plan gets adjusted mid-trade. A loss turns into a larger loss, not because they didn't know better, but because they didn't act on what they knew. So what's missing? Discipline is the bridge between knowledge and results. Without it, intelligence becomes scattered. It shows up in analysis, but disappears in execution. Think about it. Intelligence helps you identify a high probability setup. It helps you understand risk, timing, context. But discipline is what makes you wait for that setup. It's what keeps you from entering early. It's what forces you to respect your stop when the trade goes against you. Without discipline, intelligence becomes selective. You use it when it's convenient and ignore it when it's uncomfortable. And trading is full of uncomfortable moments. When price moves quickly, discipline is what keeps your hand steady. When you're down on the day, discipline stops you from chasing. When you've had a few wins in a row, discipline prevents overconfidence from taking control. Intelligence alone won't do that. In fact, intelligence can sometimes work against you. It gives you the ability to justify bad decisions. You can create reasons for entering a trade that doesn't quite meet your criteria. You can convince yourself that this situation is different. That this time, the rule doesn't fully apply. And the more intelligent you are, the more convincing those arguments become. That's the quiet danger. Because now, you're not just breaking rules. You're explaining why it makes sense to break them. Discipline doesn't negotiate like that. It doesn't care how good the setup looks beyond your criteria. It doesn't adjust itself based on your mood or your recent results. It simply follows through. That consistency is what creates stability over time. If you think about long-term performance, it's not built on isolated moments of brilliance. It's built on repeated, controlled actions. The same process applied again and again, regardless of outcome. And that's where discipline quietly outperforms intelligence. An intelligent trader might have 10 great ideas, but only execute 5 of them correctly. A disciplined trader might have simpler ideas, but executes all of them as planned. Over time, which one do you think produces more reliable results? The market doesn't reward how much you know. It rewards how consistently you act on what you know. There's also something else happening beneath the surface. When you act with discipline, you reduce emotional interference. Decisions become less reactive, more structured. You're no longer adjusting based on fear or excitement. You're following a predefined path. That creates clarity, and clarity builds confidence. Not the kind that comes from winning trades, but the kind that comes from knowing you can trust your own actions. Without that, even the best analysis becomes difficult to use, because every decision feels uncertain. Every trade feels like a new negotiation, but with discipline, decisions become cleaner, simpler. You either followed your rule, or you didn't. There's no gray area, and over time, that simplicity compounds. You start to see patterns more clearly, not just in the market, but in yourself. You recognize when you're about to deviate. You catch the impulse earlier. You become aware of the exact moment where most traders lose control, and that awareness gives you a choice. Not a dramatic one, not a visible one. A rule ignored once becomes easier to ignore again. It never feels significant the first time. In fact, it often feels justified. The setup looks strong, the timing seems right, and the rule you're about to bend suddenly appears optional. You tell yourself it's a one-time decision, but is it ever just one time? The mind doesn't treat that moment as an isolated event. It records it. It stores it as a reference point. And more importantly, it removes the resistance that was there before. The first time you break a rule, there's friction. You hesitate. You're aware of it. There's a quiet voice reminding you that you're stepping outside your plan. But after you cross that line once, something changes. The next time, that hesitation is weaker. Why? Because now you have evidence that breaking the rule didn't immediately lead to disaster. Maybe the trade even worked in your favor. Maybe you made money. And that outcome, more than anything, reshapes your behavior. Because the brain doesn't learn from logic, it learns from experience. If breaking a rule leads to a reward even once, it becomes easier to repeat. Now the rule is no longer absolute, it's conditional. And once a rule becomes conditional, it loses its power. Think about how this plays out over time. You skip a confirmation once, then again. Then it becomes something you only wait for. When necessary, you move a stop loss once, and it saves you. Now moving stops feels like a tool, not a mistake. You overtrade during a volatile session, catch a few quick wins, and suddenly patience starts to feel optional. Each small exception builds on the last. Not in a dramatic way, not in a way that immediately stands out, but slowly, steadily, your structure begins to shift. Have you ever looked back at your trading and wondered when things started to feel inconsistent? It rarely happens overnight. It happens through repetition of small allowances. And here's the subtle part. While your rules are weakening, your confidence might actually increase. You feel more flexible, more adaptive, more in control. But what you're really doing is drifting. Because without firm rules, every decision becomes situational. You're no longer following a system. You're interpreting the moment. And interpretation, especially under pressure, is unstable. When the market becomes fast or uncertain, you don't fall back on rules. You fall back on habits. And if your habit is to adjust, to bend, to override, that's exactly what you'll do when it matters most. That's how one small exception becomes a pattern. Not because you chose it consciously, but because you practiced it. So the real issue isn't the rule you broke. It's the standard you lowered. Once your mind accepts that a rule can be ignored, it stops treating it as a boundary. It becomes a suggestion, and suggestions are easy to override. This is why consistency in trading isn't just about knowing your rules. It's about protecting them, keeping them intact, even when it feels unnecessary. Especially when it feels unnecessary. Because the moments that feel harmless are the ones that reshape your behavior the most. You don't notice the shift right away. Your results might even stay stable for a while, but underneath, your process is changing. And eventually, the change surfaces, maybe in the form of a larger loss that didn't need to happen. Maybe in a series of trades that feel rushed, unclear, inconsistent. Maybe in a growing sense that you're no longer trading the way you intended. And when you try to correct it, you realize something important. It's harder to rebuild a rule than it is to follow it from the start. Because now, you're not just learning the rule, you're unlearning the habit of breaking it. So the next time you feel that quiet urge to ignore a rule, even slightly, even for a reason that seems logical. Notice what's really at stake. It's not just the outcome of that trade. Consistency in behavior matters more than consistency in results. That idea can feel counterintuitive at first. Most traders measure themselves by outcomes. A winning day feels like progress. A losing day feels like failure. It seems logical. Results are what matter in the end. But let me ask you something. If you had two traders, one who follows their plan perfectly but takes a loss, and another who breaks every rule but ends the day in profit, which one is actually improving? The answer isn't as obvious as it looks, because results in trading are noisy. A single trade, even a series of trades, doesn't always reflect the quality of your decisions. Good behavior can lead to losses. Poor behavior can occasionally lead to wins. That's what makes this game deceptive. If you judge yourself based only on results, you start reinforcing the wrong things. You reward yourself for wins, even if they came from mistakes. And you become frustrated with losses, even if they came from doing everything right. Over time, that creates confusion. You begin to associate success with outcome rather than process. And once that happens, your behavior starts to shift in subtle ways. Have you ever taken a trade that didn't meet your criteria, but it worked, and afterward, it felt like a good trade? That's the trap. Because now, your standard has changed. Not consciously, but internally. You've told yourself that the result validates the decision. But the market doesn't validate your behavior. It only delivers outcomes. And those outcomes can mislead you if you let them define your standards. Consistency in behavior removes that confusion. When your focus shifts from, did I win, to did I follow my plan, something important happens. Your performance becomes measurable in a meaningful way. You're no longer at the mercy of random short-term results. Instead, you're building a process you can actually evaluate. Think about it this way. If your behavior is consistent, then your data becomes clean. You can look back at your trades and clearly see what works and what doesn't. There's no distortion from impulsive decisions or emotional overrides. But if your behavior is inconsistent, your results become unreliable. You don't know if a win came from skill or luck. You don't know if a loss came from a flaw in your strategy or a moment of poor execution. Everything becomes blurred, and without clarity, improvement becomes difficult. This is why experienced traders often separate themselves from outcomes. Not because they don't care about profits, but because they understand where control actually exists. You can't control whether the next trade wins or loses, but you can control whether you follow your rules. That's the only part of the equation that's fully yours. And over time, that control compounds. When you repeat the same behavior under different market conditions, patterns start to emerge. You see how your strategy performs in trends, in ranges, in volatility. You understand its strengths and its limits. But more importantly, you build trust. Not in the market, but in your own consistency. And that trust changes how you operate. You stop reacting to individual outcomes. A loss doesn't shake you as much because you know it was part of the plan. A win doesn't inflate your confidence beyond reason because you understand it came from following your process. Everything becomes more stable. Let me ask you, how often do traders abandon a working strategy after a few losses? And how often do they stick with a flawed approach because it recently produced wins? Both come from the same mistake, prioritizing results over behavior. When behavior is inconsistent, results dictate your decisions. You chase what worked recently and avoid what didn't without understanding why. But when behavior is consistent, results become information, not direction. You use them to refine your process, not to redefine it every week. That's a different mindset. It requires patience. It requires restraint. And it requires you to accept that doing the right thing won't always feel rewarding in the moment. Sometimes the best trade you take will lose. Sometimes the worst trade you take will win. If you can't separate those two experiences, you'll keep adjusting your behavior based on short-term feedback. And that keeps you stuck. But if you anchor yourself in consistent behavior, something shifts. You start to evaluate yourself based on execution, not emotion. You begin to see progress in how you think, how you decide, how you act under pressure, and those improvements, while less visible than a profit number, are far more durable. Because they shape everything that comes after. Small deviations create large distortions over time. At first, the change is barely noticeable. A slightly earlier entry, a slightly wider stop, a trade taken just outside your criteria. Each decision feels minor, almost insignificant on its own. You don't feel like you've changed your system. But have you really kept it intact? Because trading isn't shaped by one decision, it's shaped by repetition. And when small deviations repeat, they don't stay small. They accumulate, they stack, and eventually, they begin to alter the structure you thought you were following. It's like adjusting a compass by just a few degrees. At the start, the difference is invisible. But the further you travel, the more off course you become. Have you ever looked at your recent trades and felt like something was off, even though you couldn't pinpoint exactly what changed? That's often the result of subtle drift. One deviation leads to another. Not because you planned it, but because your reference point has shifted. What once felt like a clear boundary now feels flexible. What once required confirmation now feels optional, and the more you operate within that flexibility, the harder it becomes to recognize the original structure. You're still trading. You're still analyzing. You're still making decisions. But are you trading your system, or a modified version of it? That distinction matters more than most realize. Because your edge, whatever it is, depends on consistency. It depends on executing a specific set of conditions over and over again. The moment those conditions begin to change, even slightly, you're no longer testing the same edge. You're testing something else. And the problem is, you don't have enough data on that, something else, to trust it. So now your results start to feel unpredictable. Not necessarily worse right away, but less stable, less explainable. You win some trades you shouldn't have taken. You lose others that don't quite fit your model. And over time, your confidence starts to erode. Not because the market is unclear, but because your process is. Let me ask you, when a trade goes wrong, do you know exactly why? Or do you find yourself second-guessing, unsure whether it was the setup, the timing, or something you adjusted along the way? That uncertainty often comes from accumulated deviation. Because once your behavior drifts, your feedback becomes distorted. You can't tell what's working and what's not. You can't isolate variables. Everything blends together, and without clarity, improvement becomes guesswork. There's also a psychological effect that's easy to miss. Small deviations don't feel like mistakes. They feel like refinements, like you're adapting, like you're becoming more flexible, more intuitive. But flexibility without structure leads to inconsistency, and inconsistency makes it harder to build trust in your own decisions. Think about how this plays out during pressure. When the market speeds up, or when you're in a drawdown, your mind looks for shortcuts. It relies on what feels familiar, and if what's familiar is a pattern of small adjustments, then that's what you'll fall back on. Not your original rules, not your tested approach, but the version that's been quietly reshaped over time. And that version is often less stable. So the issue isn't just that you've made small changes, it's that those changes compound without you realizing their full impact. Each one shifts your baseline. Each one moves you slightly further from what you originally defined as correct. And over time, the distance becomes significant. You may still recognize parts of your system. The entries might look similar. The logic might sound the same, but the precision is gone. And in trading, precision matters, because your edge doesn't live in broad ideas. It lives in specific conditions, specific timing, specific execution. When those specifics begin to blur, so does your performance. So the next time you adjust something, even slightly, pause and consider what you're actually changing. Is it a deliberate improvement, tested and understood? Or is it a quiet deviation, justified in the moment? You don't lose control in one moment. You lose it in small permissions. It rarely begins with a big mistake. There's no single decision where everything suddenly falls apart. Instead, it starts quietly, almost unnoticeably, with a series of small allowances. You let one rule slide. You justify one early entry. You hold one losing trade a little longer than planned. Individually, none of these feel like losing control. They feel manageable. They feel explainable. But let me ask you, when does it actually cross the line? Because most traders don't recognize the moment they've lost control. By the time it's obvious, the damage has already been done. That's because control doesn't disappear all at once. It erodes. Each small permission weakens your structure just a little. It tells your mind that the rules are flexible, that they can be adjusted based on how you feel in the moment. And once that idea takes hold, your decisions start shifting. Not dramatically at first, just slightly. You take a trade you would have skipped before. You move a stop, telling yourself it's just to give the trade room. You increase position size after a loss, trying to recover faster. Each action feels like a response to the situation, but in reality, they're all part of the same pattern, gradual loss of discipline. Have you noticed how it often builds? One small decision leads to another. A minor adjustment turns into a habit, and before long, you're no longer following your plan, you're reacting. And reaction is where control fades. Because when you're reacting, you're not thinking in terms of structure, you're thinking in terms of emotion, urgency, fear, frustration. You're trying to fix what just happened instead of executing what was already defined. That shift is subtle, but it changes everything. Your focus moves from process to outcome, from consistency to recovery, from discipline to impulse. And once that shift happens, your decisions start accelerating. You enter trades faster. You exit without clear reasons. You override rules more easily. Not because you chose to abandon your system, but because you've been gradually stepping away from it. That's how control is lost. Not in one trade, but in the permissions you gave yourself leading up to it. The dangerous part is that each permission feels small enough to ignore. You don't stop and say, "This is where I lose control." You say, "It's just this once." But how many times have you said that before? And what follows after that thought? Usually, another exception, and then another, until the behavior becomes familiar. At that point, it doesn't even feel like breaking rules anymore. It feels like your normal way of trading. That's when it becomes difficult to reset. Because now, you're not just correcting a mistake, you're undoing a pattern. And patterns, once formed, don't disappear easily. They show up under pressure. They surface when you're tired, frustrated, or trying to recover losses. They become your default response. So the real challenge isn't avoiding one big mistake. It's recognizing the early signs of drift. That moment when you start negotiating with your rules. When you begin to justify instead of follow. When you feel the urge to adjust something that was already decided. That's where control is still intact, but starting to weaken. And that's where it can still be preserved. Because once you become aware of those small permissions, you can interrupt them. You can pause before acting. You can question the impulse instead of obeying it. You can return to the structure you set when you were thinking clearly. That's how control is maintained, not by avoiding every mistake, but by refusing to let small allowances turn into habits. A strategy fails less often than the trader executing it. Most traders don't like hearing that. It's easier to believe the system is flawed than to question execution. After all, if the strategy is the problem, you can replace it, tweak it, optimize it, start fresh. But what if the strategy isn't the issue? Let me ask you, how often have you switched systems after a rough period only to find yourself facing the same problems again? Different indicators, different time frames, same inconsistency. That pattern isn't random. Because the common variable isn't the strategy, it's the way it's being executed. A strategy by design is simple. It defines conditions, when to enter, when to exit, how much to risk. It doesn't hesitate. It doesn't second guess. It doesn't adjust based on emotion, but the trader does. And that's where the gap forms. You might have a strategy that works over a large sample of trades. But in real time, trade by trade, things start to shift. You skip valid setups because they don't feel right. You take marginal ones because they look tempting. You exit early when the market moves against you slightly. You hold too long when you're hoping for more. Each of those decisions pulls you away from the system. not dramatically, just enough to change the outcome. Have you ever reviewed your trades and realized you didn't actually follow your strategy as defined? Maybe the entry was slightly off. Maybe the risk was larger than planned. Maybe the exit didn't match your rules. Individually, these seem like small differences. But collectively, they create a version of the strategy that was never tested. And then, when results don't match expectations, the conclusion becomes obvious. The strategy doesn't work.